It's a great question. I'm going to get over the fact that you said it's only been 335 companies,
right.
which means we still have a ways to go.
Yep.
That's our depressing thought for the morning. But no, look, I think the tagline we've been using is fine but not fabulous. And I might put a comma after that now, after having gone through last week where I think we had 155 companies. And I would say comma, starting to look messy.
Okay.
And, I think the overall headline stats are fine. The rate of upward revisions to FY1 and FY2 is like 61, 62%. That's moved up from the mid-50s. That's all well and good. We watch very closely the Bloomberg intelligence data where they track the bottom-up consensus estimates, and those have crept up for both 2025 and 2026. If you think about guidance, we've also been looking at some Bloomberg data for this as well. And so the guidance stats look pretty good. The problem is I think a lot of this was well anticipated. And so, coming into reporting season, I heard clients talking about FX tailwinds. Guess what? Stocks aren't reacting all that well to beats on FX. I've been hearing that from my analysts. And if you think about, some of these adjustments to guidance because, hey, the tariff rate isn't as bad as we initially baked in, clients knew that was coming as well. So, I think some of this is falling flat. And when we're looking at, the demand discussion, frankly, was there push-in? Was there, pull forward? Were there delays? I mean, it still sort of seems to be all of the above. The tech companies sound pretty good. I don't think there's been too much interruption on the AI story. But outside of that, it seems like there's a lot of confusion as to how much, kind of pull-in actually happened. You're seeing some companies say there's a little bit, of improvement. Some of that paralysis is alleviating. But frankly, Paul, I mean, the level of uncertainty still seems very, very high. And that is concerning me right now.
Well, even though we've had roughly 40% of the market cap by the S&P 500 reporting, now that we're past most of the tech earnings, we still have NVIDIA on August 27th. But of course, I mean, you've noted in your notes to clients, we still have a number of consumer names coming in the next few weeks. So obviously, Paul and I were talking about earlier when it comes to McDonald's, Disney, but then you still have in a few weeks Walmart and Target. So what are you expecting when it comes to the consumer front, and specifically what you might hear about tariffs from them?
So look, I don't think it's going to be awful, but it might be a little bit of cold water. And the reason I say that is if you think about sort of how reporting season unfolds, we always start out with the financials. And we even saw a couple of the credit card companies, I think last week and the week before, echoed this as well. The financials are like, hey, everything's fine. Spending is still good. And, like the delinquencies are low and people are still paying their credit card bills. And, we're just not seeing anything wrong. And then you go and actually listen to the consumer companies that watch what the consumer is actually doing. And, maybe the word cracks is too strong, but I would say the composition of the spend is reflecting a concerned behavior. One of the food companies last week actually referred to the idea of people stress eating chocolate,
right.
which was probably one of my favorite quotes from last week. But we saw other companies say the consumer is under stress, and that doesn't result in a collapse in consumer spending, but there are some concerning things going on, not just from the high end, but the low end as well. And the Michigan survey on Friday actually showed a downtick in consumer sentiment for low end and lowly educated consumers. So there is something amiss. We're going to hear more about that, is my guess.
And also promotions, because consumer packaged good companies, especially coming into this year, we're talking so much about those types of, you're at the grocery store, buy one, get one 50% off. What are you hearing so far with any of that?
So I haven't been paying quite as much attention to the promotion conversation, but this whole idea of the value-seeking consumer ranging from like the high end to the low end is still very much, present. And, I've noticed some of the food companies have been talking about things like smaller pack sizes. I mean, this is sort of going with my own lived experience as the mom of like two little boys who just eat and eat and eat. So I think that value consciousness is still translating into behavior, and you're seeing it, especially for these food companies. There's another company, I forget who it was, but they were talking about how food has just become so much more expensive that it's radiating in terms of other purchase decisions. And so they can really see where consumers are prioritizing their spend.
Small to mid-cap stocks, what's the call these days?
So, it's interesting with all these developments in the last, 48 trading hours. I think the Fed meeting last week threw some cold water on the small cap trade. And Friday was a little bit of a mix, right? Because on the one hand, we got this jobs report that said, okay, there may be some deterioration in the labor market that's beyond what people had assumed. That is bad for small caps. You need jobs growth to be ramping, to be getting better for small caps to outperform. Typically flat to decelerating jobs growth doesn't work for them. That being said, Small caps have become the hedge fund community's one of their favorite ways to express Fed bets. And so, when people sort of settled down, and started to think about, okay, maybe the cuts are coming sooner, we'll see how they trade today, but that feels like it should breathe a little bit of life into markets and a little bit of life into small caps. So I would not be short small caps, but I don't have enough conviction to go long yet either. I'd be neutral.